Good afternoon, Claire Smith here. We hope everyone's been having an amazing summer, and I'm just here today to give our July market update. Really, after a roller coaster of a year from bear market territory to new all-time highs, we're currently sitting at another all-time high in equity markets. It's been a week of corporate earnings results and updates on trade negotiations, so we thought it was a good time to give an update on where we sit right now and our outlook based on analyst expectations and broader economic indicators. So starting with global and US growth in the economy, growth or GDP projections have slowed for major economies. Looking at the US specifically, the US GDP growth was revised down from year-over-year growth of 2.2% in October to 1.8% projection more recently. But any continued downward revisions are going to be based on hard data, which have yet to materialize to support this. The primary reason, specifically around tariffs, is that we haven't seen the tariff impacts sink into the hard data yet. And while negotiations are ongoing, we won't know the full severity. Additionally, the labor market is still relatively strong. There are some softening indicators with hiring, but we're currently at pretty low unemployment levels. So this brings us to the Fed. They are extremely data dependent, as we know, and they're not going to be making large moves until they get that data, which has certainly been getting a lot of criticism the last couple of weeks. I know we've been seeing a lot of that in the media right now. But with that said, the broad consensus is that we will be getting 2 more rate cuts this year, starting in September most likely. So the Fed rate target is currently sitting at 4.25% to 4.5%, and by year end, so we're expecting the 3.75 to 4% level. And rate cuts historically have given a lift to equity markets, and borrowers we know are thirsty for more affordable loans, which will have some lag to trickle down into things like mortgages and equity loans. But for bonds, specifically in your portfolio, that means locking in higher income rates now will prove to be really beneficial and can also see some positive price movements for currently held fixed income securities. So back to our all-time highs and where do we go from here? Really many analysts, including Goldman Sachs Research, have just recently revised upwards their year-end price targets for the S&P 500. The consensus, as you'll see on the screen, is a 6,600 price target for the S&P 500. This is up from the June projection of 6,100 at year-end, and their 12-month was 6,500. So this is a significant upward revision and marks a 4 to 4.5% upside from where we sit today for year end. So why did this happen? And the answer is also on this chart here, and that is earnings. So corporate earnings have blown expectations out of the water, specifically communication services, financials, and technology sectors. Continued earnings growth, if we see this go on, this will be a tailwind for the equity markets, along with rate cuts as well, which we previously mentioned. The headwinds, on the other hand, lie within the ongoing uncertainty around tariffs. So we have that August 1st deadline next week where we'll hopefully have some clarity, but major industries are still at play with some pretty large numbers. But the most recent negotiations out of Japan from this week were positive, and we'll be watching which negotiations follow suit and which will remain elevated. But we'll continue to keep you all updated as usual, and please feel free to reach out with any questions. Have an awesome weekend and stay cool, and thank you so much.